Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I am the host of Stocktake, the podcast from Intelligent Investor. For a free trial, please visit www.intelligentinvestor.com.au. I have here two guests who were hosts of the episode 2 weeks ago. I'd like to thank you for standing in. I thought you did an excellent job. So good, in fact, that I'd like you to do it more regularly. How do you feel about that?
Oh, yeah. The man asks not what he wants. He doesn't know. He doesn't know what went on. You just saw the finished product.
No, I listened to it. I really did listen to it.
The shenanigans behind the scenes,
good.
John.
It was very good, and I think we should start from now because the subject we're going to address today is very complicated, and I'm not sure I can really handle it. There is euphoria, and there is also kind of chaos and weird things going on. So I thought we might tee up the conversation by just talking about some of the things that are going on and then reference valuations, which is where the majority of our discussion is going to be today. So firstly, there's a Middle East war on two fronts now with the US taking sides. While that's going on, everybody seems to have forgotten about the US-China tensions. The Russia-Ukraine war didn't get fixed in 24 hours as promised. I want my money back. Tariffs could go to 100% again at any time because there's a mad king in the White House and China remains in a property slump. Inflation still pretty high, really, and so are real interest rates in comparison. That's causing a lot of sovereign debt servicing problems, or might do that. There's also the threat of stagflation. Consumer confidence is low. And the only positive in all of this is that Tottenham won the Europa League a couple of weeks ago. So stocks are as expensive as they were before the dot-com crash when everything in the world was pretty good. So we'll start off with Nick. WTF is going on, and why is Wesfarmers on 40 times earnings?
Well, it's become very hard to explain. I mean, yeah, as you said, Wesfarmers at almost 40 times earnings. I mean, how do you justify that? Look, when you look at that business, I think Bunnings is the best business inside of that.
Yeah. And
Bunnings' peers in the US, Home Depot and Lowe's, they trade at like 20 to 25 times earnings. And you can make an argument, and I probably would, that they're just as good or better businesses than Bunnings. And Bunnings might be even a more mature business because it has 50% market share. Its recent half-year report, they were growing at 3%. So how do you justify a conglomerate like Wesfarmers that also includes Officeworks, Kmart, an industrial business, and a pharmacy business trading at 40 times when you can't? Well, I struggle to justify their best business that should garner that multiple. So I find that hard, but it's one of many examples. CBA is the obvious one that I'm sure
that's the one everybody's talking about.
Yeah,
the most expensive bank in the world. And by some margin.
Exactly right. I mean, it's 30 times earnings. So it's, I think almost double the valuation of most of the other Australian banks, almost double the valuation of JP Morgan, arguably the world's leading bank. It's, I think, triple the valuation of Lloyd's in the UK. And then this number really shocked me. It's now at above 4 standard deviations from its long-term average.
Wow.
And I had to sort of.
I don't know what that means, but it sounds impressive.
Yeah, well, I had to sort of go back to sort of high school math to work out what that means. And it's a 1 in 50. Well, it's a 1 in over 15,000 statistical occurrence, and that's actually selling it short because the standard deviation is more like 4.5 times. But at 4 times, it's 1 in 15,000 statistical occurrence. So it's just.
Should we just pause the podcast for a couple of minutes and just contemplate that? That's kind of astonishing that the most, I wouldn't call banks boring because, they just sort of live on debt. So that makes them quite exciting in some respects. But for a stock that is probably the most popular stock on the ASX and that is really not really growing very much at all, it's growing at GDP growth plus a bit. I imagine. How can that be? What's going on, Gaurav?
No one has the answer.
Nick's
this
silent.
is the
Gaurav,
question.
tell me what. Then there's got to be. We must try and hazard a guess at this. I've got one possible explanation. I'm sure it's the same as yours, but have a crack.
Well, the standard explanation for this is just money flows. The power of passive money is now enormous, and it's showing up not just in valuations, but it's showing up in the way people invest as well. There are now funds who are trying to guess, their investment strategy is trying to guess which stocks come in and out of these indexes. And by picking correctly what goes in and what goes out. And then, by the way, that's not hard. It's pretty easy to see what's going to go in and what's going to go out. Those stocks experience now strong rallies and strong falls when the prospect of them entering and exiting these indexes is clear. And that's because ETF flows are moving the market, passive flows are moving the market. Now, that's I don't even think that's a bad thing. I really welcome that. As an active investor, you have an enormous and growing pool of unthinking money chasing a small number of stocks. There's the top 20, 50, 100 stocks. And that means there's a large amount of ignorance and dislocation in the rest of the market. I think, to me, that sounds like opportunity. I'm pretty happy to play in that part of the market.
Do you think there's anything else going on other than that? Because do you see other stocks in the top 50 that trade on the same kind of multiples?
No, it's a good point.
With the same kind of percentage weightings that aren't at those kind of multiples.
Yeah, you're right, John. BHP kind of is the problem for that argument, because BHP is the second largest stock, and indexes should be buying that, and they're not, because that's a very cheap valuation. It's kind of interesting almost.
Mm.
So that's probably part of the explanation, but it can't be the entire explanation. I don't think I think a lot of value managers in particular spend too much time pondering about the why. It's not really important. I don't think about why that is. All I need to know is that buying it at 4 times asset value and 1% NPAT growth is not a good deal. It's just not a good deal. It doesn't matter what the price is doing. It's a poor deal. So that's enough information for me. I'm happy just to walk away at that point and not have to consider it after that.
All right. Thanks for listening, everybody. We decided we don't need to have this podcast after all. Nick, do you want to add anything to that as to why it's... Because I am curious about the reasons for it. I do like to know why something has happened rather than just accept the fact it's happened. I think I'm not unusual in that. Gaurav is probably more focused on value than maybe me in that sense. What else would you add to that argument? Gaurav, you can go and make a cup of tea for another 5 minutes if you like.
Well, the thing I would add is the story has developed over time. So it used to be you pay premium for CBA compared to the other banks because it's the best run bank. It's historically had a higher return on equity, and that made sense. And then that premium started to grow, and people were like, "Oh, well, we're just going to pay a bit extra because it's a really well-run bank, and the others aren't as well-run." And then it kept growing, and it was like, okay, well, a lot of passive money is chasing that stock price now because the stock price is up, and it creates that effect where if your stock price rises, the index has to buy more, and then you've got other investors like superannuation funds that now have their performance benchmarked, and they have to buy more because they don't want to get behind other superannuation funds and et cetera, et cetera. But now I think it's just got to almost unexplainable levels, and it is hard because I'd like to think that we can find the answer to these things, but as Gaurav said, it might be this time to say, well, I just know it's a really bad deal rather than why it's happened. But there is just so much momentum trading going on in the market. If you look at if you just take 5 fund managers and look at all their reports, my guess is a lot of them own the same stuff, and you just while those those stocks have performed very well, you don't want to be following them into these stocks at these prices because it's just this big herd mentality. No one wants to admit they own a loser, but that's probably where some of the best opportunities are. It's certainly not in buying CBA at 4 standard deviations above above its long-term average.
That's what's curious. Since I would say over the last since 2021, maybe 2022 in particular, it's you've been rewarded for momentum. Momentum is the factor that's actually generate the best return.
Right.
And historically, I would say over the past century, you've really needed a more contrarian approach. I mean, the best returns have come from taking contrarian positions to the market, and then something unexpected happens, and your returns kind of jump. And that's no longer, for the last few years, that has not been working. And as that's not been working, more and more people have been jumping on this momentum train, and that obviously increases the momentum.
Yeah, there's a kind of an accelerant factor.
Yes, that's right. And Nick's point is right. It's very interesting to go through fund manager quarterlies and see that most fund managers, whatever they purport their strategy to be, they may be quality investors or growth investors or value investors, they're all holding the same stuff, the same 5 stocks. We can probably name them if we want, Nick.
Go on then.
Well, they're all holding GDG. What's that stock called? Development something. Generational development.
Oh, yeah.
Catapult, Technology One, Zero. Not so much Pro Medicus, but Pro Medicus is a bit of a special case, I would say. Let's probably put that to one side. And maybe Wise Technic.
Yeah. This is certainly for the
Goodman Group.
Yeah,
Goodman. Yeah,
Macquarie. Now the list goes on. I mean, these are the names that everyone's owning universally up and down the chain of strategy, and these are the stocks that have performed. And I suggest those two things are linked. People are owning them because they've performed, and they've performed because people are owning them. It's a chain that is difficult to break, but it's not one I would suggest you don't want to be a part of that chain, because it will break eventually, and it's going to be ugly when it does.
And it becomes a bit self-reinforcing over time too, because most of those stocks we just mentioned, I think we would all agree are great businesses.
Yes, that's right.
And they have moats, and management teams are good, but at some point, it just becomes silly. But when you look at one of these quarterlies or a fund manager's holding, and you go, oh, well, they're all really good businesses. Oh, the share price has done well. Oh, that's just what good businesses do over time.
Yeah,
the share price just goes up. And this becomes self-reinforcing, and then you get the passive money on top.
Yeah, you're right. Valuation had just gone completely, valuation discipline has gone out the window. And I actually think acolytes of Buffett have largely should accept the blame for this. I think the lesson people have learned, and they've learned it really well, is that patience is rewarded, buy the dips, and quality matters more than price. And independently, all those things are true. But the old those old Greek philosophers, they used to think virtue was
Greek philosophers.
Well, virtue was a balance
So we've
between
got Nick the psychologist and Gaurav the classics man.
Yeah. Aristotle.
They used to say that virtues were a balance between two behaviors. So the courageous person was neither reckless or cowardless. There's something in the middle. And I think the same is true for those investment virtues as well. They exist in the middle, but you can take them to extremes. And I would say patience is now taken to an extreme, and there's not enough fear in the market. Every time the market wobbles, the prices fall. There's 2 days of falls, and everything just bounces. Everyone's just buying the bounce. This is not healthy.
All right. I think we've made our point on this in this regard. I'm going to hazard one more sort of kind of longer term perspective to this idea of momentum, because there is a psychology behind momentum. And if you asked anybody, say a year ago, that tariffs, the US would implement tariffs at 10%, and ask them what the effect of that would be on stock prices, they would have said massive falls. And yet they're at higher than 10%, even after all of the pullbacks, and the stock market is at record highs.
Yep.
It's an incredible kind of situation, and I can't really explain that. But what I feel as though is important is the reason behind the momentum is that for about 20 years now, ever since Greenspan, who had this thing called the Greenspan put, where every time the stock market wobbled, they'd lower interest rates, and investors would be bailed out. I would say the market has kind of ceased to function in the way we expected it to. Like nobody's being punished or penalized nowadays for dumb decisions, because they expect somebody to come along and bail them out, either with lower interest rates, fiscal stimulus, tax cuts for corporations. It seems to be endless. And we have now sort of built a whole generation of investors who think that stock prices only go up. And if they do go down, they don't stay down for very long. Yeah, which we know historically isn't true. Stocks can stay cheap for decades. You can ask a Japanese investor to answer that question. So I think that is the psychology perhaps behind the momentum trading, because that's all we've seen for a long time, and we've kind of most investors have kind of drunk it in. So let's now move on to the consequences of this, because it's not as if you can't find cheap stocks, right? And the question for investors, I think, is if you own stocks like Wesfarmers and the banks and all of these big stocks have got a lot of momentum behind them and are trading at historically high and incredible multiples, what should you do with your portfolio? And the obvious thing to say is, well, you take some money off the table and put it somewhere else. So let's talk about the pockets of value that we might see in the market right now, Nick, because it's not as if our buy list is devoid of entrants. It's quite rich at the moment.
Yeah. I think, well, to start with, you want to do the opposite of what everyone else is doing. So if everyone's herding into these stocks, you probably want to avoid those. So you want to be looking at some of the unloved sectors. So there's certain commodities, I think, that are on our commodity stocks that are on our buy list, some small cap businesses that have been forgotten. Another area I'm finding more and more attractive, and this goes to the point about momentum, is any companies that have had a hiccup. So when a company misses earnings at the moment, their stocks are just absolutely savage. It's kind of crazy when you think about, they've missed earnings for 6 months, but the business has been around for 50 years and the stock price has been cut in half. If you can come to the point of view that it's just a short-term hiccup and take a long-term or patient approach, there's some really, really good opportunities. And there's, I think, a few companies on our buy list that would fit the mold there. And it's, again, this is completely the opposite of momentum trading. It's the stocks that have been forgotten that look the most attractive to me at the moment. Even those traditional
they are momentum trades, but the momentum is heading in the other direction.
In the other way.
Yes, yeah, exactly right. Yeah, and then I guess internationally, and I think I've mentioned before, the UK continues to look cheap just as an overall market, and it's not just the sort of low PE names; it's even their high quality businesses. So one we cover is Auto Trader. It's essentially the car sales of the UK. So if you're a used car dealer, you sort of have to use Auto Trader. It's got about a 75% eyeball share, but it trades at 20 to 22 times earnings, whereas car sales here is available sort of 35, 40 times. And if you look at the financials of these two businesses over time, Auto Trader's kept pace with car sales. It's doubled its earnings growth, doubled its EPS over the last sort of 8 years, and it's got a growing dividend, and the future looks pretty bright. So there's some of the areas I'm looking at.
Any other comparisons like that, Nick, between UK price stocks and Australian equivalents? Because you can make the argument, I suppose, that a lot of the classified businesses are like that when you look at local Australian stocks compared to European or US multiples on similar stocks.
I mean, you can make the case for Rightmove as another business we cover, which is essentially the REA of the UK. Its valuation has increased, but REA recognised how good that business is, and they tried to acquire it last year. I mean, REA was trading at over 50 times earnings, and Rightmove at the time was about 20 times earnings. So there are, the best companies in these sectors are recognising how cheap some of these UK businesses are. And then if you look at a more traditional sector like banking, I think I mentioned before that Lloyds, which is one of the largest UK bank, trades at I think a quarter or a third of the multiple of CBA, yet is paying sort of 10 to 15% back to shareholders with dividends and buybacks. So yeah, there's some more examples.
Gaurav, what about you? What areas do you feel are attractive right now?
it's not really, I guess there's no real broad area, but there are certainly individual
Stocks.
names that are just maligned and forgotten and cheap. I think one area where we've done well over the last 12 months is slow growing, high dividend paying stocks. Stuff like EVT, Brickworks, Chorus, Eagers. Those things are all up sort of 50% plus in terms of equity, and they are paying 5% plus distributions, 6%, 7% distributions. And they've just been, I was amazed at the prices we got to buy those. We basically bought EVT at below asset backing.
Yeah.
Brickworks has always been below asset backing. And I admit we got lucky there with the merger that no one saw coming.
Well, we waited 25 years for that.
Yeah. But also made great returns while we waited. Eagers has been almost a double with great dividends, and Chorus has been more than a double with great dividends and distribution still growing. All these stocks, and there are a couple more I haven't mentioned, all those stocks were easy to see, were quite easy to analyze and understand, but were just forgotten because they weren't growing very quickly, even though they're quite solid businesses and you can generate very good returns from them. I think there's a theme there that the market's chasing one type of return, and that's just growth. That's the only thing that's being rewarded.
There's no momentum behind yield.
Yeah,
It's boring now, especially now that you can get 5% sticking your money in the bank.
And I also agree with this idea that any business that that's had a hiccup or is going through a funk, that's just been crushed. And once the share price goes down, no one wants to know about it. And again, that sort of suggests that the market is running on momentum. It's chasing higher share prices and forgetting about businesses.
Yeah.
And that's where we've had a lot of stuff on the buy list, is stuff that has gone through a bit of a funk or has gone through a bit of a speed bump. And I think there's still raging opportunities in that sort of area.
Yeah. I mean, we should say that we started the podcast with a kind of sense of incredulity about prices, and that would suggest we're all sitting on lots of cash. We're not really. There's plenty of stocks out there that we really like, and Gaurav's just sort of dropped a few names, and so has Nick. And it's actually quite an exciting time. The problem is that you're not making as much money as the momentum traders right now.
But you're also taking on, I would argue that
the risk that you're removing,
the risk
when you buy these companies.
And I think that's key. The risk weighted returns have been really attractive. I think people have forgotten this idea that the more you pay for a stock, the higher risk you're taking. And paying triple digits for a stock is not always a terrible idea. But you are taking high risk. You're counting on the future to turn out in one particular way with a greater degree of certainty.
Yeah. It's much easier to imagine that the Commonwealth Bank stock price could halve rather than double.
I would have said that at half the price, John.
Yeah.
And it would have been true, though,
make the
right?
same point. Yeah, or you could have another scenario where the share price goes nowhere for a decade and the earnings slowly catch up. But even then, it's probably still expensive. It maybe might need to go nowhere for 2 decades and the earnings slowly catch up. But yeah, I can see that sort of happening as well. Like, rather than CBA halves overnight, more I see that as maybe a more likely scenario where some of these stocks that are highly valued just sort of trade along and just go nowhere for a few years as earnings catch up.
All right. I think we're going to call it a day now. I will say to listeners that we are putting our prices up quite a lot. And we have a special offer on now that allows you to beat the price rise. We feel as though there are some very attractive stocks paying reasonable yields, good potential for growth that are just being ignored in this kind of environment. They're the stocks we're buying for our own portfolios. They're the stocks we're recommending for members. If you would like to beat the price rise, this is a good time to join us. So it'd be nice to have you aboard. Nick, thank you very much. And Gaurav, thank you very much. And we'll be back with you in 2 weeks. Speak to you then.